All right, let's actually talk about what's happening in the San Diego real estate market this month. Because yes, the rumors are partly true. The market is cooling, but it's not crashing. Honestly, it feels like San Diego just took a big, deep breath. Hey, I'm Greg Kuchon here with Compass, and I help people just like you navigate the real estate market across San Diego. And today, I'm going to break down what changed over the last 30 days, where the market's heading, and why I think 2025 was the actual correction people were waiting for, but they didn't really want. So let's get into the data. Detached home prices and condos dipped about 2 to 3% this year. Nothing wild, just a little reality check. Fun fact, luxury sales are still very, very strong, which means the averages are being pulled up, while the median market, the typical home that most people are buying here in San Diego, it's softening slightly. Detached homes, the inventory actually tightened, down 1.5%, while condo inventory jumped 10%. That's why condo buyers have more leverage in today's market than detached buyers. Month supply of inventory is 2.5 months for houses and 3.3 months for condos, which means it's a seller's market overall, but much more balanced than it was last year. Days on market shot up to 41 days on the market for a detached home and 45 days for attached homes, which is up 12 to 20% for each one of those categories from last year. Translation, buyers finally have time to think and maybe even go to brunch, see the home more than once before writing an offer. Yeah. So, mortgage rates. Mortgage rates have been down and drifting slowly down from the peak of 2024, which means monthly payments are finally backing away from that like exotic sports car feeling of like, oof, do I need this? Applications are up too, which is one of the best leading indicators here in real estate. Now, let's talk about something big because I get this question pretty much daily. Greg, is the market going to crash? When is the market going to crash? Here's the honest answer. Most people, when they say they want the market to crash, they mean they want the prices to fall. But the price is only one part of the real estate market. The other pieces are inventory, demand, absorption rate, and just the sheer number of homes that sold in the county and across the country. And when you look at the full picture, this is what's actually happening. We actually did see a crash, just not in the prices. We saw a crash in the inventory and the number of transactions. The number of homes that actually sold fell massively across the county and across the country. Meanwhile, prices held steady or dipped slightly because of fewer people listed their homes and demand stayed longer and stronger than expected. A few markets like Tampa, Austin, Phoenix did see real price corrections, aka prices went down, but the rest of the country, the crash was a collapse in activity, not prices. Even today, about 30% of all listings here in San Diego take a price reduction before finding the right buyer, which is normalizing, not collapsing. Now, the data looks a little weird right now, which we have a lot of outlier markets here in San Diego. Those outlier markets are skewing the national data as well. Luxury markets are still breaking records, which pulls the averages up. But if you zoom into the middle of the market, we're seeing the median buyer and seller prices are actually slightly lower than last year, while the luxury sales are keeping the charts looking stronger than they've ever done. So, what are the leading indicators of what's telling us what's going to be happening in the market? So if we want to know where the market's going, it's mortgage applications. More importantly, the pull-through rate of those mortgage applications, meaning how many people actually got the home after they got pre-approved. Demand increases well before supply. So if the rates drop meaningfully, demand will spike instantly, but supply, that takes a little longer. And if demand spikes faster than new listings can come to the market, the absorption rate increases and supply tightens, which has exactly happened during COVID. So my 2-year forecast, I'm calling it right now. 2025 was the correction everybody has been waiting for. Maybe not the one they wanted, because it wasn't a price correction, but it was a volume correction. And then over the next 2 years, we're going to move into an appreciation market again. So not crazy COVID levels of appreciation, but steady, healthy appreciation, between that 2 and 6% rate. So 2026, I think it's going to be a very, very stable year. Normal year. Boring year. Very small price growth. A little more affordability, hopefully, if wages continue to rise and job reports keep going well, so we can have some softening of the rates. But 2027 looking forward, I think we'll see more and more appreciation and inventory continues to stay structurally low, right? There's just, as the demand increases, supply is going to stay low, prices will keep going up. So what does this mean for you? Buyers. This is the best leverage you've had in years, so maybe it's time to think about doing something. Sellers, pricing and preparation matters now more than ever. You have to make your home stand out. Be the best house on the block or the best deal in your neighborhood. You're going to get tons of offers and the price is going to go places where you didn't think it'd go. But if you're kind of sitting average, you're going to get the average results. So if you want a personalized strategy based on your specific situation, just reach out. I'm always here to help navigate this market with clarity and confidence. See you next month.